I'm Dawit Kebede, Senior Economist at America's Credit Unions, here to bring you our updated economic and credit union forecast. America's Credit Unions forecast team just released its fourth quarter outlook. And there is cautiously good news. We're seeing slightly better economic growth prospects than we projected last quarter. However, significant risks remain on the horizon, and growth will stay modest and below the economy's full potential. Trade and fiscal policy uncertainties, a shrinking labor force, and rising cost of living pose risks to the projection. We're also dealing with an ongoing government shutdown that involves the potential for permanent layoffs of some federal workers. But it's not all doom and gloom. We saw consumer spending coming stronger than anticipated during the summer, which will show up in Q3 economic growth data. Potential continuation of this spending and booming investment in AI by corporations provides some economic lift. The labor market can no longer be described as solid, although the unemployment rate of 4.3 is still low by historical standards. Even with hiring down, there are less workers in the labor force. This has kept the unemployment rate relatively stable. One thing to note is the total number of foreign workers is down by about 1.5 million since March. Employers added an average of only 29,000 jobs per month during the summer. June showed a net job loss, highlighting just how weak hiring has become. Initial benchmark revision also showed the economy added over 900,000 fewer jobs than initially reported for the 12-month ending in March. Inflation reached 2.9% in August, up from its low point of 2.3% in April. We're seeing some tariff impact on imported goods prices, but the full effect will take more time to materialize. The effective tariff rate currently sits at 17.9%, down from its peak of 28% in April, but still way above the 2.4% rate we saw at the beginning of the year. Low consumer sentiment and negative views about the labor market could lead to lower consumer demand, which may help offset price pressures. The Federal Reserve noted in September that employment risks have risen and inflation remains above 2%. Most Fed officials expect 2 more rate cuts this year. However, assessing the current economic conditions is harder because the government shutdown has disrupted data collection from key institutions. Now let's turn to credit unions. Performance in the first half of 2025 was mostly in line with our forecast. We've lowered our share growth projection to 5% for 2025 and 6% for 2026. Share growth in the first half of the year was stronger than last year. The regular and share draft accounts saw outflows. As interest rates decline next year, we expect slight improvement as alternative money market options become less attractive for members. For loans, growth will remain below the long-run average. Auto and home prices are still high for the average member, and interest rates remain elevated despite some expected easing next year. However, conditions are improving for mortgages. Home price increases are moderating, and active listings increased 17% over the past year. This improved housing supply, combined with lower rates ahead, should continue to boost mortgage activity. Credit union first mortgage loans have already improved in the first half of the year. Auto loan growth, however, is expected to remain subdued as consumers' car buying sentiment remains low. We've raised our delinquency projection slightly for 2025 due to 3 reasons: non-prime borrowers struggling with auto and credit card payments, the resumption of student loan collections, and a denominator effect due to slower loan growth and a higher proportion of auto loan repayments originated in 2022. The good news, we see some of these factors easing relative to our previous forecast. So we lowered delinquency projection from 1.1% to 1%. Finally, credit union earnings should improve next year. Net interest margins have increased, and provisions for loan losses are stabilizing as credit unions have built steady allowances. The bottom line, we're cautiously optimistic again. That's a trend, but for a reason. There is anxiety about the labor market and rising prices. But even with all that background noise, growth prospects have improved, recession risks have declined, and credit unions remain on solid footings despite challenges ahead. That will do it for this month's economic update video. Thanks for watching, and we'll see you next time. Bye.